Okay, let's go ahead and continue with our discussion of partnership changes. Now, in the previous presentation, we went through the example of a new partner admitted while paying a premium. Now let's go ahead and see what happens when a new partner comes in at a discount. So again, let's have the ABC partnership. And let's say they've got capital balances of 300,000, 400,000, and 300,000. And they share profits, profit loss percentage, 20%, 30%, 50%. Total net assets, $1 million. Let's say D wants to enter. And let's say D pays $300,000 for a 30%. Oh, let's make it more than that. Let's make it a 40% ownership share. Again, first order of business, we have to determine whether D is getting in at a discount, at a premium, or exactly book value. So again, we start with our net assets. Current net assets are $1 million. Add D's contribution. So after that contribution, total net assets will be $1.3 million. D's share is going to be 40% of that. Or $520,000. So D is getting in at a pretty sizable discount, paying $300,000 for $520,000 of capital. Okay, once we get to the conclusion that D is getting in at a discount, we again have our two basic methods. Bonus method, easy. Bonus method, there's going to be a cash contribution of $300,000. Leaving some space there. D is going to get a capital balance of $520,000. That difference, again, basically D is getting $220,000 more in capital than he or she is contributing. That $220,000 bonus is going to come out of the capital accounts of A, B, and C in that 20, 30, 50 ratio. So A is going to bear 20% of that bonus. So we're going to reduce A's capital balance by 20% of $220,000 or $44,000. B is going to bear 30% of that $22,000 or $66,000. And C is going to bear half of that bonus or $110,000. So again, bonus method, nice and easy. Now, the goodwill method or the asset revaluation method, again, we ask ourselves, why is D getting in at a discount? And there are two possible, I guess there are a number of reasons, but the two things that come immediately to mind are maybe D is just an excellent person. You really want to have D in the business. He's great for schmoozing clients. He brings some sort of great technical skills. For whatever reason, the partnership really, really wants D to enter as a partnership. So they say, look, D, whatever you want, we'll give it to you. We'll give you more capital than you pay for. So maybe D brings some additional value with them. Maybe D is bringing value above and beyond the cash that he's contributing. In other words, maybe D is bringing some other intangible attribute like goodwill. Alternatively, we could say, look, maybe D is getting in at less than book value because book value is overstated. Right now we've got net assets of $1 million. Again, net assets is nothing more than assets minus liabilities. Assets at historical cost minus some perhaps arbitrary depreciation measure minus liabilities. So maybe those assets are overvalued. Maybe there's some goodwill on the partnership balance sheet that really doesn't exist anymore. So maybe instead of arguing that D is getting in because he's bringing some additional value with him, maybe we could turn that 180 degrees and say, no, the partnership just isn't that valuable. Let's go ahead and make up a little story to go along with this. Let's say that A, B, C, and D sit down together with the accountants and the appraisers, and they say, look, you've got $150,000 of goodwill on your balance sheet that needs to be written off. So, again, D's getting in at a discount. Maybe one of the reasons D is getting in at a discount is because the partnership isn't worth its full book value. Maybe once we write down the assets down to fair value, maybe that discount disappears. Maybe, in fact, D is paying more than the fair book value of the assets. So let's go ahead and write down that goodwill first. So we're going to go ahead and credit goodwill. And again, you could alter the story so you're writing down any asset they might have. Maybe they've got overvalued equipment they've been depreciating it very slowly, but it's obsolete. You can tell any sort of story you want. For whatever reason, assets are overvalued. We need to lower the value of the assets. And again, that impairment loss is going to be allocated amongst the partners in a 20-30-50 ratio. So A is going to bear 20% of that. So 20% of 150 is 30. B is going to bear 30% of that. And C is going to bear half of it. Okay, so first order of business, and this would be actually the case if you're going to use the goodwill / asset revaluation method. This really should be the first order of business, whether the partner is buying in at a discount or a premium or what have you. First thing you should do is go ahead and say, look, what is the actual value of the partnership? Do we have to write some assets up? Do we have to write some assets down? So go ahead and write our goodwill down by $150,000, and now we'll go ahead and revise this calculation. Okay, now, our net assets, we've dropped these things. Because of this goodwill impairment, A's capital is down to 270. B's capital is down to 355. C's capital is down to 2.25, totaling $850,000. Again, we got rid of a chunk of their goodwill. So now let's go ahead and go through this. Is D buying his way into the premium or discount again? So we say, okay, the net assets are $850,000. D's contribution is going to be $300,000. So after D makes that contribution, total net assets will be $1,150,000. D's share is going to be 40%, or whatever that is, $23.46. So D is still getting it at a discount, but the discount isn't as big because we sort of met them halfway. So look, you're paying less than book value, but we're going to write the book value. We're going to write the book value down as part of the process. Now, under the goodwill or asset revaluation method, we say, okay, we've cleaned up the balance sheet. We've revalued the assets to fair value. D apparently, again, D is paying $300,000. His share of the capital is going to be $460,000. D is apparently bringing some other attribute with him or her that makes him or her a really desirable partner. This intangible attribute is, again, going to be goodwill. In this case, though, the goodwill wasn't, unlike the case where D bought his way in at a premium, when D bought his way in at a premium, that goodwill already existed and was created by A, B, and C. In this case, D is the one bringing this goodwill with him. So we're going to go ahead and create some goodwill, but it's going to accrue to D. And now the big question is, how do we compute that amount of goodwill? Now, when we had D getting in at a premium, we computed the implied or apparent firm value based upon the price D paid divided by D's ownership share. We're going to do the same thing now, but we're going to do it based on the previous partner's balances. So the previous partner's capital is $850. So we say old partner's capital, $850,000, divided by the old partner's ownership share. Now again, after D enters, D's going to have 40% ownership, so the old partners are going to have 60% ownership. And I can't do that in my head. I could, but not quickly. So the implied firm value is $850,000 divided by 0.6, or $1,416,667. Again, the implied firm value based on the old partner's capital balance and the old partner's ownership share. Okay, so now again we say, look, the existing assets are $850. D is going to contribute $300,000. So there's going to be a tangible or identifiable net assets of $1,150,000. We've determined that the firm value is actually $1,416,667. So basically, we need to write the firm up. We need to write up their net assets from $1,150,000 up to $1,416,000. So that's what, $266,667? And so that's going to be the goodwill that gets created. So we're going to have existing net assets of $1,150,000. We're going to write that up. We're going to write up goodwill of $266,667. And by doing that, when we record D's contribution, let's see where we stand after doing this. Total, the total assets of the firm, try to clean this up a little bit. Okay, so we have the initial net assets of $850, we added D's cash of $300, we add the goodwill of $266,667, add all that stuff up, we get $1,416,667. And D's share is 40% of that. And basically that's going to be that and that. So 1416,667 times 0.4 is 566,667. Which is precisely what we gave to D as his capital balance. And his capital balance was the $300,000 in cash that they actually paid in, plus this goodwill of $266,667 that he contributed. Now again, when doing these, think of we have a very specific process we follow. First order of business, determine whether the partner is getting in at a discount or a premium. That's the first order of business. Once we do that, we have, again, our two possible ways of doing this. The bonus method is easy. Basically, the difference between what the partner contributes and his or her share of the resulting net assets, that's a bonus either given to or taken away from the old partners. The goodwill method is a little bit trickier. If the partner bought his or her way in at a premium, we get the implied firm value based upon the new partner's contribution and the new partner's capital share. If the new partner bought his or her way in at a discount, as was the case here, the implied firm value is based on the old partner's capital balance, 850,000, and the old partner's ownership share after the new partner comes in this case, 60%. In any event, what you really should do first is, and this I guess, honestly, this applies whether you're going to be using the bonus method or the goodwill method. Before you even get to the question of, is the person coming in at a discount or a premium, if there are assets that need to be revalued, you should revalue those first. Whether, again, some people are a little leery about revaluing specific assets. If you want to do that, if you think that's appropriate, you should revalue those assets first, so you're sort of starting with a set of good numbers. Okay, so after this, one more thing to talk about, which is going to be partner retirement, and then we'll be done talking about partnership changes. Cool beans.